Hi, this is Geoffrey Dohrmann with Institutional Real Estate Inc., and welcome to this edition of View from the Top. Today we're talking with Scott Brown, who's the CEO of Cornerstone Advisers. So, welcome, Scott.
Thanks, Jeff.
Scott, you've been with Cornerstone for almost a year and a half now, and you transitioned to the CEO role, I understand, in January. How do you like it?
I absolutely love it. Cornerstone's a great company. I've known a lot of the folks there for a decade or more, particularly the executive team and the investment teams. So when the possibility was suggested, I pounced on it because it's a great group of experts that like to have a lot of fun delivering performance to clients, and there's a lot of camaraderie. There's a great culture, collaborative environment. It's a great company. It's a great group of people, and I'm really happy to be. I'm honored to be part of it, and honored to be at the top. To be honest.
You know, you mentioned working hard, and I notice you guys do, but I also notice you seem to have a very nice culture for work balance and really a lot of respect for family and helping people kind of balance that. I think that's a nice attribute of the company.
It really is. I'm a firm believer. Look, I have a family that I love, and I love spending time with. And I don't want anybody not to have that benefit, to be able to spend the time with their family and see their kids grow up and spend time with their spouse and see the world a little bit. So, work hard, play hard is kind of the mantra, and we don't play too hard, but we do have fun doing it. And then once we get the work done, and then we say, good to see you. I'll see you tomorrow or after the weekend, and make sure that people have a good time away from the office to balance out their life, because it's so important, particularly in this day and age of 24-hour access to everybody. We want to make sure that people get their downtime so that they can live a balanced life and come back refreshed and come back energized and ready to go and thinking about the client.
Now, you're sitting in a CEO spot now, and while you've been operating globally for many, many years, different position, you've got tremendous amounts of incoming information. How do you make sense out of it? I mean, what do you see, for example, as the most important economic drivers in today's environment? And what are you paying attention to? Which indicators are you watching?
Yeah.
And I know it changes over time.
It does change over time. So the way we make sense of it is we have a big research and strategy commitment. We spend a lot of time developing our house view, looking at relative value across the globe, sector by sector, and challenging ourselves to develop and redevelop preferred strategies quarterly. That's a top-down and bottom-up process, so it's a research and strategy-driven process from the top. And then we have hundreds of investment acquisition professionals, asset management professionals out in the field, managing properties, seeing what's going on with tenants, seeing what's going on with leasing terms, feeding into that process. So we feel like we can get a real good handle on relative value around the world. Some of the things that we're paying attention to closely at this point are macro-prudential central bank policy around the world and what's going on there and how that could possibly affect economic GDP growth. Certainly the U.S. we see as a driver of the global economy at this point, and when we look at the U.S. we're very focused on the employment labor statistics. We're seeing good growth, which is good. We have a hiccup, it seems, almost every first quarter for the last 5 or 6 years. But we pay a lot of attention to that, and then we parse it out, make sure we understand folks that want to be working full-time that are partially employed, or folks that want to be working full-time that are unemployed, the duration of unemployment, and really in particular participation rates, and then sectors and categories that employment's taking place. Because ultimately we need to understand how companies are growing, why companies are growing, how they're employing folks, how they're utilizing space, in order to make smart investments for our clients.
Okay, we'll get back to market picks in a minute, but one of the trends that we've been seeing, I mean, we've been living in a globalized world for a long time. The world is flat, all of that sort of thing. But I don't recall a time when I've seen as much cross-border capital flows as we're seeing right now. How do you see that impacting your business from a strategic perspective?
Yeah, it absolutely impacts our business. We are global, so prospects, clients, investors around the world see the Cornerstone name and invite us into an engagement to have a conversation about their markets, about markets around the world, and that leads to good conversations about what is happening around the world, why a global portfolio makes sense, how you can build a global portfolio and reduce risk, and still achieve your performance goals. There are very large capital inflows into the U.S. at this point. There's a lot of capital chasing yield, chasing income. The spread for real estate, whether it's a cap rate spread to either our risk-free rate or others at risk-free rate outside of the U.S., and it's very attractive still from a non-U.S. point of view. So cap rates are low on very stable, long income property types, property sectors, and they likely will continue to be as long as we still have attractive spread in those spots. So core has become a very competitive market in that regard. And there's capital coming from Europe, but there's also capital coming in from Asia at this point, and quite a bit.
Some of that capital doesn't appear to be yield driven. It seems to be more looking at real estate as a store of value as opposed to a yield play. And that makes it very, very difficult for people to compete. How is that impacting your strategies looking forward?
Yeah, so I agree with that. That some folks seem to be looking at it as extremely long. Look, the different investors have different durations, have different target returns, have different performance objectives and goals, and you have to balance that and make sure you're investing specifically for that portfolio into investments that achieve the performance with the least risk possible. So overpaying for an asset, for a good asset in a prime location in a gateway city, is almost as risky, or perhaps more sometimes, than getting a little bit further out on the risk curve, the risk curve, and doing and rehabbing a building, redeveloping a building, even developing a building in a market where there's demand and supply has not yet started to meet that demand. So we focus on the whole balance and making sure we're investing to achieve clients' goals.
So looking around the globe and thinking about these capital flows, thinking about the role of central banks, thinking about how that's impacting people's decision making for where to deploy capital, which are the markets around the globe that seem most interesting to you and your firm right now from a strategic perspective?
Yeah, so the U.S. is still the most attractive market from an economic point of view, from a real estate space point of view. So occupancies are up in almost all sectors across the U.S. That's putting pressure on rents. So we're actually very active in all 5 primary property sectors in the U.S. at this time. We're careful not to get into a market and overpay. We're careful not to get into a tertiary market, but certainly non-gateway cities that are very large and cities that still have a lot of economic drive and a lot of demand and not a ton of supply coming on are still very attractive in the U.S. at this time. So we see the U.S. as the growth engine for the global economy at this point. We're very active in the U.S. We're a 4-quadrant investor in the U.S., so we're in public, private, debt, and equity. And that gives us a lot of information to be able to understand markets, not just from a space point of view, but from a capital market point of view, and be able to use that knowledge to understand relative value across sectors, across quadrants, and make smart investments that achieve our clients' goals.
Now, you say you're looking at secondary markets more aggressively than you were in the past, and I understand that. All secondary markets, or some more attractive than others, and what are the factors that differentiate the more attractive markets from the ones where you kind of, even if they're strong secondary markets, you wouldn't really want to venture into?
Yeah, great question. So when we look at any market, whether we consider gateway or secondary, or whether others consider it gateway or secondary, we're certainly focused on employment growth, income growth, but also where humans are clustering and why humans are clustering. We find that people are clustering, companies are hiring into more populous areas because of the educated employment base that they need access to. So you've heard it before, I'm sure, work, live, play, making sure that people that work there have access, that properties are walkable, whether it's where you live, whether it's where you work, or whether it's where you want to go to get your entertainment, if they're close to each other, you have a better chance of getting attracting demand for that space.
Okay. And then looking forward, where do you see the greatest opportunities and threats facing you, facing your clients, and what are the implications? What are the next steps for them and for you and as a firm?
Yeah, so we see a lot of opportunity right now. We think the U.S. has an expansion for at least 3 more years. We see the macroprudential policies that the ECB has implemented to be extremely helpful to the European Union. So we're the opportunities we're taking advantage of are all 5 property sectors in the U.S., from core to value add to development. We're active in all those. We're also active in high yield lending in the U.S. So whether it's a bridge loan on a value add property or whether it's a construction loan on a development property, we also find non-U.S. investors need an asset liability match. So we have a large core mortgage group, and we see a lot of activity there right now. And in the high yield and the core mortgage areas, the regulatory environment is helping folks, the private lenders, because banks are highly regulated, other institutions are highly regulated and have difficulty getting the capital out into what is regulatorily considered higher risk investments. We also see a ton of opportunity across Europe. We're in the UK, we've been doing London office, we've been doing light industrial, we've gotten fantastic results on that over the last couple of years. We're in the Nordics, we've been doing a lot of retail investing in the Nordics. We still see that as attractive. We're redeveloping property in Malmo at this point. We just sold a property in Västerås. We have folks in Helsinki. We own some big retail in the Finnish markets, particularly in Helsinki. And we just bought a company in Germany called Primera, now called Primera Cornerstone. We see the 5 largest cities in Germany being very attractive. Germany being a large manufacturing economy, and being able to have a low currency in the euro, that's very attractive for their export prices, and that should help them drive their economy and their GDP going forward. With regard to threats, China's pivot to the consumer, that's a threat. It's a macroeconomic threat. They have the 2nd largest economy in the world, emerging, but nonetheless, if they're the 2nd largest economy in the world, it's hard to believe that they're still emerging. They have a lot of space to run on macroprudential, and they have the ability to make strategic decisions quickly with a small number of people and redirect. China should be fine, but they are pivoting, and they will have slower growth over the next couple of years. So that, I think that's a threat to not only Asia Pac but the global economy, because it's all connected at this point. I hate to say it, but sadly, terrorism is a large threat for any business, any person. But if it happens in a particular city, then now what? We saw the TRIA get reinstated at the beginning of the year, thankfully, so we can still get insurance to cover that. But you worry about the people, you worry about the assets, and of course, fear is not a good demand driver for any economy. So that's also a big problem. And then some of the things that we worry about in just managing a company are cyber threats and the like. So economically and real estate investment wise, there's not a ton of threats right now. We're in a slow expansion after a massive financial crash. Financial expansions take very long durations of time, at least historically. We think we have at least 3 years left in the U.S. expansion. We think Europe is a couple of years behind the U.S. with regard to macroprudential policy, and therefore there should be good growth there on a go-forward basis. So we're pretty bullish at this point.
Scott, Cornerstone's been growing both organically and through acquisitions. What does the future look like for the firm? Do you continue to see that kind of growth pattern, and what will be the drivers there?
We do. So the drivers there are our vision at this point is to be able to provide any investor, regardless of their base currency, attractive investment opportunities around the world. In order to do that, our philosophy is we need to have boots on the ground near the real estate that understand the culture and the regulatory environment and understand the demand drivers and live the demand and supply drivers. We do plan to continue to grow in the U.S., but in the U.S. we're really sticking to our knitting, so we've been reinforcing our current team. We've elevated a couple of folks in the U.S. to global positions to help me to grow the company and to make sure we have consistency of processes and make sure our investment processes are repeatable around the world. So we're going to grow organically, most likely in the U.S., although we have seen some attractive corporate opportunities, and we will continue to look at corporate opportunities. And when they're a strategic fit, we'll pursue them. We just bought Primera in Germany in July 2014. We are looking at other opportunities in Europe and have a couple that are active at this point that I can't expand on. But as we look at markets, as we look at product types, as we look at economies, that not only drives our investment decision making for our portfolios, but it also drives our investment decision making for the strategic direction of the company. So at this point in time, we're very focused on completing our European platform expansion. So we've had the UK because we bought Protego in 2010. We lifted out a Swedish and Finnish team in the Nordics in 2011, 2012 timeframe. We bought Primera in 2014. We're now looking at Spain, Italy, and France and building small investment teams for equity and debt in those markets. That'll give us a pan-European platform, and that will allow us to pursue a couple of strategic opportunities that we want to pursue, namely a value-add fund, a pan-European value-add fund in Europe, and a pan-European core fund in Europe.
Now, we're seeing a lot more debt-related funds in the market. Do you see this as kind of a reaction to the GFC in terms of filling gaps in the market, or do you see the long-term trend, and why?
Yeah, great question. So we have a large debt group. We have an alternative investments group that does structured debt, high yield debt, and we have a core mortgage team. We are not in both of those businesses for the short term. We've been in those businesses for long periods of time. We plan to stay in those businesses. I think you're right that the market did react to the GFC. That creates an opportunity to access properties potentially below their fair value through debt instruments. We've done that before. We see others do that. That allows others to build a debt team or redeploy equity folks to a debt strategy. And when there's a temporary dislocation, there are very attractive returns in that market. Now those spreads have come in. We plan to stay there. We still see very attractive risk-adjusted returns in that market. Regulatory environment is removing some of the prior lenders from the marketplace. So the private market is filling that gap and taking advantage of that gap and providing that. So, but we still see very good spreads in the U.S. We do a lot of floating rate bridge loans on value-add deals, construction lending. We're looking to do the same in Europe. And we have a debt team in Europe, which is a couple of people at this point, but we're working on expanding that dramatically, patiently, but expanding it dramatically nonetheless over the near term to make sure that we have that in place for the long term, and we have the capability in Europe. The other thing that I think drives debt strategies is capital stack. So coming out of a global financial crisis, there's fear in the market, and it takes a long time for the fear to dissipate. Being at a more protected spot in the capital stack and being able to get equity-like returns on your money is more attractive to some investors in the marketplace at this point.
Okay. It's about all the time we have, but love to be able to have you come back and do this again, and really appreciate you being here and taking the time to do that.
Thank you very much for having me.
Thanks so much for looking in on us today.